Okay, hi everybody. This is Mr. Manning, and this video is going to be a little bit of a follow-up to our previous videos about credit. So if you remember in our previous videos, we spoke a lot about different types of credit, what makes you credit worthy, what a credit score is, how they determine your credit score, just all sorts of things related to credit. And in those videos, I did mention this thing called APR, which stands for annual percentage rate. And I said that that basically is like the cost or how much it's going to cost you to borrow money or to get a loan. So this particular video is going to be a little bit more detailed about what APR is. And then there's going to be a little bit of math involved because depending on what your APR is, it will determine like what your monthly payments are on a particular loan. And basically it just kind of relates to your loan in general. So, all right. So here's the things that I'd like for you to have open on your screen if you don't already have open. I've got a copy of the PowerPoint here. You have a copy of that as well if you would like one. And then probably more importantly is I also have this one page of fill-in-the-blank notes. We're going to talk about what is APR. You're going to talk about like different types of APR depending on the type of loan you get. And then down here at the bottom, we're going to do several examples about how to calculate your loan when you know your APR. Okay, so let's go ahead and get started, shall we? All right, so what is APR? Well, I already said that APR stands for annual percent rate. And it's the way that lenders, those are the people that are letting you borrow money, so usually the banks, it's the way that lenders determine how much money they are expecting when a loan is repaid. Some people refer to this as the interest rate on the loan. So if you hear somebody say interest rate, they're probably talking about APR and vice versa. Most people use those two terms interchangeably. They mean the same thing. So what it is you know, whenever a bank gives you a loan, it doesn't matter what the loan's for. It could be for a new house or a car or college or even just a credit card. Whenever they give you a loan, they're going to actually determine what annual percentage rate you're going to receive. And they can determine this from a lot of things. It's mainly your credit score. Based on your credit score, they will assign an annual percentage rate to you. But it also will have something to do with the type of loan, because certain types of loans have certain types of annual percentage rates related to them. And we're going to talk a little bit more about that later in the video. Okay, so is the APR the same on every loan? Well, I basically just answered that. The answer is no. Everybody receives a different APR for different reasons, depending on their credit score and depending on the type of loan they are receiving. Okay, so the type of loan. Loans like home mortgages, car loans, and student loans usually come with a fairly low APR. Let's talk about why that is. So mortgages and car loans, the reason they have a low APR is because they have collateral related to them. And I spoke about this in a previous video, but basically if something happens on this loan where somebody is unable to pay it back, the bank will actually just repossess the car or the house or whatever it is that the person used the loan to purchase. So therefore, the bank is a little more comfortable offering a lower annual percentage rate because they know that if things go bad, they have collateral that they can seize. Student loans are usually low APR because they are actually backed by the government. So whenever you receive a student loan, you actually generally get that loan from a bank, but the government is kind of like insuring that loan, saying that if you were to not pay it back, that the government would take care of it. Now, that doesn't mean that you get off scot-free and you don't have to pay back the loan because the government's going to bail you out. But what it does mean is that the banks have a little lower risk with that particular loan because the government is there to take over if you're unable to pay. Now, Other types of loans have higher APR, and credit cards are probably the one that are best known for having a really high APR. And the reason these are is because credit cards, you can use them on anything you want, and the things that you purchase don't necessarily have collateral related to them. So, for instance, if I use my credit card to go out to dinner, and then in a month I can't pay my credit card bill, well, there's absolutely no way that the bank can come and take my dinner back from me. I mean, that's impossible. So those types of loans generally have higher APR. Now you might be thinking, well, this kind of sounds like installment and non-installment, and that's basically what it is. If it's an installment loan where you're going to pay the same amount every single month, and you're using the loan to get some type of large item that usually has collateral with it, then the APR is going to be low. And then if it is a non-installment loan like a credit card, then the APR is usually going to be high. Here at the bottom, I also put a quick little thing about payday loan places. You've probably seen payday loan places, maybe even seen their commercials. Payday loans have extremely high APRs. Extremely high. Some of them can be over 100%, which is unbelievable, right? But they have extremely high APR. This is one reason why a lot of people are very negative about payday loan places, and why there's been some recent things happening with the government and in the news about trying to reduce the APR that payday loans are allowed to charge. Okay, so a person's credit rating definitely depends on what APR they're going to get. People who have good credit scores receive loans with lower APRs. Two people could get the exact same type of loan. So two people could go to the exact same car dealership, buy the exact same car for the exact same amount of money, and the person that has a good credit score would pay less money for that car. And the reason is because they would receive a lower APR. And then over the length of the loan, over the 4, 5, or 6 years, because they had a lower APR, they would be paying lower payments versus the person that had a bad credit score and had to pay higher APR and higher payments. So credit scores, not only are they extremely important for you and your ability to get a loan, but they're also very important with how much you're going to spend on the loans that you get in the future. I put right here, this is why keeping a good credit rating is so important. It will save you lots of money in the future. And that's true. You want to get the lowest APR possible on every single loan that you apply for, and having a good credit score is the best way to do that. Okay, and then one other thing that banks use to determine the APR is the current state of the economy. So when we were talking about the 5 C's of credit, one of the C's was called conditions. And I told you guys that conditions means the current state of the economy. There's this thing called the Federal Reserve. They're a very important part of our financial system. I'm not going to go into a lot of detail about them, but basically they control the APR for the entire country. Now, that is not saying that they control the APR for every single person on every single loan. That would be really difficult for them to do. But they set what's called a national interest rate. And that interest rate fluctuates slightly, but depending on how the economy is doing, the Federal Reserve sets that interest rate. And that's the interest rate that they charge banks when banks borrow from them. So what ends up happening is it's kind of like a trickle-down thing. Whatever the Federal Reserve sets their APR at, banks end up using that as kind of like a guideline for the APRs that they give to their customers. So as the Federal Reserve adjusts the APR, it will also affect you as a customer getting a loan from that bank, because it might fluctuate up and down. Usually what happens if the economy is very good, APRs are actually kind of high, which that seems kind of weird. Why would an APR be high if the economy is good? It's mainly because the Federal Reserve is charging a higher interest rate to borrow their money. And then on the flip side, if the economy is bad, the APR actually goes down a little bit, because the government sometimes uses the APR to help stimulate the economy. They want people to be borrowing money and to be spending money. Okay, now we're going to do a little bit of math. So we're going to talk about how to calculate a loan payment using this APR. So here's the process. You take the total amount of the loan and you divide it by 100. Okay, and then you take that number and you multiply it by your APR percentage. And then finally, you take that number and you add it to your original loan amount. Now, the number that you get at the very end will be the total amount that you're going to be spending on that particular loan over the lifetime of the loan. This is also assuming that the loan is only for 1 year. If it's for multiple years, this would actually be done multiple times. All right, so here's a quick example. I'm going to do one with you guys, and then I'm going to let you try a few on your own on the next slides. So we got this guy named Johnny, and Johnny's going to borrow just $100, and I chose $100 just to make the math kind of easy. And he has got an APR of 7%. Okay? So if we're going to go through the math on this, we would first take $100 and we would divide it by 100. So 100 divided by 100 equals 1. Okay, pretty easy. We would then do 1 and we would multiply it by the APR percentage. So 7, 1 times 7 equals $7. And then we would take that $7 and we would add it to our original amount. Basically what this $7 represents is this is how much it is costing Johnny to borrow 100. The bank is giving him $100 and they're saying, Johnny, when you repay us back, we expect $107. So it's $7 more than what you borrowed from us because of the interest rate. Okay, let's try one more. We have a lady named Sue here, and she borrowed $2,000 at an APR of 12%. Okay, that's kind of a high APR, but this is probably a credit card. So we're going to take Sue's original amount, which is $2,000, and we're going to divide it by 100. So 2,000 divided by 100 equals 20. We are then going to take that 20 and multiply it by 12. I got 12 because of the percentage rate right here. 20 times 12 is $240. We're going to take 240, we're going to add it to the original loan amount. So 240 plus 2,000 equals 2,240. So Sue borrowed 2,000. The bank says, Sue, when you pay us back, we expect 2,240. So it's costing Sue $240 to borrow that amount. Okay, there are a couple more of examples here. At this time, I'd like for you to pause the video and attempt those on your own. I do have a full explanation of each one on the PowerPoint, so if you need a little bit of help, you're welcome to do that. All right, so hopefully you didn't have any problems with doing the math on that. You will have a couple of questions similar to that on your summative, so make sure you understand the math. Okay, let's talk about this very last thing here, monthly payments. So most loans require you to pay back the loan every month. And especially if it's an installment loan, you pay back a certain amount every month. If it's a non-installment loan like a credit card, then the amount that you pay back can fluctuate depending on how much your balance is or what the minimum payment is. Monthly payments do not affect the APR at all. Basically, all they're doing is they're taking that amount that you owe the bank and they are dividing it by 12 to break it into months. So like we'll go to Sue's example here one more time. So on Sue's example, we determined that she was going to owe $2,240. All the bank would do is take this number and divide it by 12, and then they would tell Sue, okay, this is what your monthly payment is. And then after 12 months, Sue should have paid $2,240 total. Okay. I do have a really tough one here at the very end if you want to attempt it. It's not going to be something that you'll find on your summative because it is kind of difficult, but the main reason I put it on here is I wanted you to see how ridiculous the APRs are at payday loan places, because this is actually a very real scenario. A lot of payday loan places would have a scenario like this. So if you want to attempt it, go for it. Okay guys, thanks for watching.